Welcome to you both. Victoria, I'll start with you. Big pop higher in the major averages. You got the S&P up almost 2%, the NASDAQ finishing up more than 2%, the Dow as well up 1.6%. You saw some big moves in treasuries. What do we attribute this to?
Well, I think you have a combination of elements going on. Apple's earnings were good yesterday afternoon. That's supportive of the market. We had a labor report this morning that at initial sight looked like it was going to be a hot report. Then you go back and you look at the revisions and say, wait a minute, that 3-month average that we have there has gone now from a peak of almost 400,000 down to around 220,000. So maybe you're starting to see some weakness combined with what we're seeing on the JOLTS report bring that down. And then you had JP Morgan come out and actually upgrade some of the regional banks. So I think you combine those three things together, it gives you a little bit of pop here in a market that's had a rough couple of days. Okay, then, Tony, let's talk about fixed income. I know, great day for equities if you're in those, but in fixed income, we also, it seems, are just about at the end of the hike cycle. What does that mean for closed-end funds? PIMCO's got some of those. What does that mean for how investors should be positioned there, especially if you had shied away from fixed income over the last several years?
Hi, John, and thank you. You know, history isn't always the best guide in terms of what to do next, but looking at history, and we think this is a good guide as to what to do next in fixed income. Looking at core fixed income back to 1978, which is the time when most make references back to core funds, core fixed income, there's stable fixed income assets, including treasuries, corporate bonds, mortgages, for example. They've outpaced cash 90% of the time since then, and over a 3-year period on a rolling return basis by about 3 percentage points. And so what an investor is supposed to do, since core fixed income tends to do well toward the end of a cycle, specifically around 4 months before the end of the last hike on average, is start to shift from cash to core fixed income. This means your total return type funds, for example. Investors may have trouble doing that because they have long memories from last year and the losses they had in those areas. But thinking ahead, it looks like now is the time to be shifting to these core fixed income products.
Tony, I'm curious about the reaction we saw within fixed income, within the bond market to the Fed, and the fact that we actually saw a pull forward in expectations around cuts this year. Your thoughts on that? And given the fact there is so much uncertainty out there, and we can point to the regional banks as well, how to be positioned going into this time period?
Well, again, and the answer is a little bit nuanced because the answer in part depends on where you are on the yield curve. So we would say that the shorter part of the yield curve, let's say a 2-year Treasury note trading at 3.9% today, with the funds rate over 5%, seems a little bit low to us. So we'd be underweight in that area. We'd also be underweight the long end of the curve, which therefore means we'd like the belly of the curve. This is a point in time when you'd think that perhaps the Fed might want to consider waiting a bit before it contemplates a rate cut, because think about it, the inflation rate is still well above its target at over 5% for the consumer price index. Now, one final word is that the average time between the last hike and the first cut, previous cycles, is 7 months historically. There usually is a gap. And when there's a reason to lengthen that gap, like the high inflation rate, you have to worry whether markets are a little ahead of themselves in thinking about the rate cuts.